Joining me now for more on these results from Philadelphia to explain all of this is he's Mike O'Rourke. He's the Chief Market Strategist at BTIG. And Mike, great for you to be with us. And, look, these guys are still talking on this conference call, but your takeaway from these results?
I think the results were fine overall. The reason most investors who like the big bank stocks today is because they're expecting the banks to get through this process, this crisis, and these big credit provisions you're seeing, they expect them to eventually turn into earnings in the future. The downside was JPMorgan didn't give much new visibility that they see the credit trends improving. Not a big surprise because of the level of unemployment in the country right now, but earlier visibility would have been a better thing. So I don't see where the stock's trading now, but before I came into the studio, it was trading roughly the same place where it was yesterday morning, before it ran into earnings.
Mike, Scarlett was just giving us an update on the reasons behind that lower compensation number from JPMorgan in the fourth quarter. Give us your gut. With the other Wall Street firms, what is this end-of-year compensation story going to look like, knowing that you've got the UK bonus story, more equity versus cash for senior executives? What do you think?
I think for a lot of these firms, it's definitely going to be more conservative than they've been in the past. But I think when you take the Main Street perspective, which is what most people care about, it's not going to seem that different. So that's why you see actions like the president took yesterday, because to him it doesn't, he doesn't care if the average comp is, $380,000 versus or $410,000.
Yeah. Hey, Mike, it's Adam. Let me jump in here. In theory, JPMorgan has some of the better credits. If JPMorgan is still setting aside 4.2 for credit cards, 4.2 for retail, does that mean that the smaller banks have some real problems that we're going to hear about over the next few weeks?
I'm not sure about that. I think most of the problems we'll talk about at the smaller banks will be on the commercial real estate side, whereas the bigger banks don't have that issue. The bigger banks are more the consumer credit, the mortgages and the credit cards. That's where the issues are. So there's a little difference in what goes on. But we also have to remember JPMorgan is probably the most conservative big bank out there, and they're always, they pride themselves on that fortress balance sheet. So they're always going to be very cautious when they give that type of guidance.
Yeah, and you heard, what I thought was interesting in Jamie Dimon's statement in the press release was that he acknowledged that they fell short of expectations in returning capital to investors. Given that, were they too cautious, did you feel, from this quarter?
Well, this is the really interesting thing. As the crisis was going on, people flocked to JPMorgan as the bank with the fortress balance sheet, as the safest one, as the most conservative, because they had probably some of the best underwriting standards going into this crisis. But when you come out of it, and as the economy improves, that rising tide of the economy is going to lift all boats. So a bank with a more aggressive balance sheet is likely to perform better. So people, when they look at putting a position on, they might shy away from a more conservative institution if they see a recovery on track and go to someone who's been more aggressive, because that rising tide will help them a little more.
Okay, Mike, we've got to leave it there, but thanks so much for joining us. That was Mike O'Rourke of BTIG.